Hello, everybody.
Hi, everyone. Thank you so much for joining. As always, I'll give it a couple minutes to let people kind of join, and we'll give a couple minutes to make sure everyone gets connected, and then we'll kind of dive in. But Chris and I were just chatting about how we got into the space, what we both did growing up. We both were servers at restaurants for pretty much our whole high school, college lives, and how that led to where we are now, which has been a pretty interesting conversation. I've been enjoying it.
No, apologies for calling you Australian, but we went through sort of the dialects and sort of the inflection of accents and sort of living overseas and whatnot. So, Emma, thanks for having me today.
Yeah, no, super excited that you're here. And for everyone who's wondering on the Australian comment, I'm actually from England, and we figured out that a Australian accent is essentially an English accent with American intonation. And that's why I sound very Australian.
With apologies to all of our Australian friends out there.
Yeah, not to offend anyone, but I would love to go to Australia. I've never been, but it's definitely on my bucket list. And maybe I'd fit in quite well because most people get.
You just might.
Yeah. Awesome. So I know that we'll have some people kind of joining as we get started, but wanted to officially welcome everyone. Thank you so much for joining. My name is Emma Summers, and I am the Director of Business Development here at Vector. Just a little bit about us. We are a premier fund admin focused on closed-ended alternative investment vehicles. We provide back office support for funds in the venture capital, private equity, fund-to-fund, digital asset, real estate, and private debt space. Oh, that was a mouthful. But I'm super excited to be sitting here with Chris Shen, who is the COO and co-founder of Revere. And today we're going to be talking about what LPs look out for when investing in emerging managers. And we're also going to touch on, some other types of managers as well. But before we dive into questions and Chris's background, just a couple of housekeeping things. We'll be spending just about 45 minutes chatting through some questions that we've put together. And then 15 minutes at the end, we'll go through questions that you might have in the audience. So if you look on the bottom right-hand corner of your screen, you will see a little question box. You can open that up, type in the questions, send those in to us. We'll be keeping track of them. And then at the end of the session, we'll go through those questions. But feel free to throw them in kind of as we go through some of these. If the question is relevant, we might be able to touch on it kind of as we're chatting through that topic. We will also be recording this session. So in the case that you're not here joining us live, you'll be able to watch this after on YouTube. And I'll also send out a follow-up email with the link to this recording, also a little bit of information about Revere and Chris, and a way to get in contact with Chris and the Revere team if you're interested in learning more about what they do. So to kick things off, Chris, it would be great if you could give a little bit of a background on yourself and what Revere does, and then we can dive into things from there.
Absolutely. And Emma, thanks again for having me. So Revere, I'm Chris Shen, co-founder and COO of Revere. We founded Revere in 2020, based in San Francisco. Essentially, we are not a fund admin. What we do essentially is help allocators around the world make better decisions based on sort of their data and sort of their portfolio management and sort of tools. We sit at the intersection of workflow, AI, and automation. So if you think about when you've invested as an allocator, getting that data in, cleaning it up, letting you manage it, deriving insights, looking at your portfolio, so you can hopefully go and invest in more funds and more investments in a risk-adjusted and sort of careful way. My background, Em and I were talking about sort of our respective sort of paths to kind of do this webinar. I'm originally from Texas, spent 13 years in Asia, 2006 to 2019, in corporate finance roles, but I spent time as a family office investor out in Hong Kong, where I oversaw sort of fund investing for anything from pre-seed to growth buyout, hedge funds, credit, everything in between. It was my experiences there, and then reconnecting with my co-founder, Eric Wu, who is from the institutional funded fund side, essentially to come take our sort of collective experiences and essentially help allocators make better decisions based on sort of the learnings that we went through as very different investors. So I'm really happy to be here, Emma, and looking forward to chatting more today.
Yeah, thank you so much for that background. I originally met Angela, who's on Chris's team, and I hadn't heard of a company that did what Revere did. So it was really interesting to learn how you're utilizing that data, how you're, working with both LPs and fund managers, and thought it'd be a really cool opportunity that we get to sit down and chat through some of this stuff together. So, Chris, you mentioned that you've worked with a lot of different types of funds in the past, and you do at Revere as well. And I know that today's webinar, we have, a little bit more focused on the emerging manager side. So just to set the stage, can you explain to the audience what you deem as an emerging manager?
Sure. Emerging managers, I would say everyone has their own definition. I think there's no sort of 100% readily accepted nomenclature around that, but it's pretty straightforward, at least the way sort of most allocators see it. It is not a Blackstone. It is not a KKR. It is not a Ares. It's not a Sequoia or Andreessen, right? When I throw these names off, off the bat, I think most people will immediately know, sort of, at least have heard of what these fund managers do. Some of these managers are publicly listed on a stock exchange. Others are not, but they manage billions upon billions, if not more, of investor capital. When we think of emerging managers, we think of, usually sub $200 million in terms of AUM, collect, maybe a fund 1, 2, but we see 3, 4s, and 5s that are not nationally recognized or internationally known, but they're essentially doing very interesting things, usually with a specialty in a particular sector, asset class, or type of strategy. Mm-hmm. So emerging managers, rough ballpark, sub $200 million under AUM, not a nationally known brand, so to speak, and usually with a specialty or a niche focus in their investing field.
Okay, that's super helpful. So broadly, what are some of the key criteria that LPs typically consider when they look to invest in an emerging manager?
It's a great question. So when you think about, when we talked about the emerging manager definition, how that kind of stratifies in sort of different categories, investors, we'll call them LPs, have sort of, again, they're all very different. They have different risk return profiles. They have different, risk tolerance, different investment horizon, et cetera, cadence, et cetera. So their definition of emerging managers and what they do to do their portfolio construction, their allocation, can be very different as well. But essentially, when they're looking at emerging managers, you can differentiate emerging managers, some with an established track record, whether they built it at their own firm and or they are bringing that firm that's attributed to them when they worked at another sort of business or another fund manager, right? So they have a track record to evaluate. There are other emerging managers that, again, do not have a formal track record, or they're not able to disclose it. It's not attributed to them, which makes it a little more challenging for an LP to evaluate that manager, right? We all know that past performance is not indicative of future results. Everyone disclaims that everywhere under the sun. However, when you're basing when you're looking for experience, you're looking for team, you're looking for operation know-how, value add, and all these different levers that managers can pull, investors have to look to that. And that sort of forms the crux of the issue when emerging managers are trying to raise capital from LPs, but don't necessarily have the attributable track record.
Yeah, so it sounds quite similar from the other side, where you have a fund manager who's, investing in a startup founder. It's quite similar, metrics that they look to when making that decision.
Oh, absolutely. So, yeah. Sorry. Absolutely.
Yeah, I was just going to ask the next question, but if you wanted to add anything to that.
Oh, I was just going to, my apologies, didn't mean to jump the gun. When you think about a startup founder like me, in this environment, a lot of startups are going through sort of their ups and downs and sort of figure out the market, pivoting, et cetera. But choosing a partner in terms of a startup or investment target, whether it's a real estate group or someone that's being carved out of a larger conglomerate, your capital partners bring capital. It's very important, but also their value add when you're evaluating them. So the evaluation chain in terms of LPs give money to GPs to invest, and the GPs look at targets. There's an evaluation process across the board for who that partner will be.
Yeah, that makes a lot of sense. So in line with kind of key criteria, are there any specific strategies that LPs use when using to identify some of these managers?
Absolutely. So a lot of managers, when you look at sort of base portfolio construction, if you're thinking interest rates will go this way, or there's an election, or there's an event that may create an impetus or a catalyst for returns, LPs will then go evaluate managers that can fit that bill, fit that profile, and sort of get their exposure or express their view on the markets that way. The usual, and we talked about track record, We talked about sort of the different levers they can pull. There's certain funds, if you're talking about like private equity, sort of leverage buyout, what teams they can do to exact or extract benefits in terms of cost cutting, but then applying sort of levers for growth and then sort of amplifying that company into different markets. So market entry, experience in different countries matter, right? We typically deal with, in Revere, I guess the plug, we have the world's, we think, largest community of emerging managers and venture capital, about 550, if not more, that we have within our network. The collective is something you should check out. We can send more information on that. But within that, we look at the data and sort of all that. We've distilled down basically 20 different metrics where we think an investor like me or an endowment, a pension, other family office would evaluate when they're looking at an emerging manager that may not have the brand or the heft of an Andreessen or a Benchmark or a Lightspeed. I think coincidentally, these are a lot of the managers that Vector services in terms of they're probably big and small, but they're all sort of in that range. And when we're evaluating and underwriting that manager, we look at the team, we look at firm management, revenue in terms of how they're able to help their companies generate revenue. We look at their bench. If it's a solo GP, obviously it has certain risk if he or she is in a car accident, right? Hopefully it doesn't happen, but that fund would fold. There's always sort of the element of community where, again, proprietary communities, if you're looking at sort of a fund manager that is attached to a deep tech accelerator or sort of looking at, sort of technology from a specific lab that no one gets access to, that's interesting. There are a lot of managers that talk about proprietary in terms of, I went to this university, so I know this. But a lot of people went to different universities, so that sourcing mechanism in that community may not be proprietary. So all in all, we look at 20 different metrics, and we're happy to share that with anyone that's interested in being evaluated in terms of being a GP or LPs looking to make better decisions.
Yeah, that's pretty interesting too, because I think those metrics that you mentioned. A lot of the times, like we'll talk to funds who are early on in fundraising or setting up their marketing materials. And I think that's something that could be considered when you're setting up your fundraising deck as a manager is like, these are these key points that a lot of LPs look to and what they're going to use when making that decision. So definitely reach out to Chris for those points. But so we've been talking, or you've mentioned a couple of times track record. And I know that's kind of one of those components that people always talk about when considering investing in an emerging manager or any fund manager. But can you, elaborate on how the track record is used? What LPs look for in that track record?
Yeah, I think it's again, it's when you put aside kind of the illusion of past performance indicates sort of future, past results, future performance. You put that aside. I think that's essentially what investors are looking for, right? They're looking at sort of the ability to source, be a signal in the networks that they are to look at deals, because deals are, the best companies, if you look at sort of the AI craze, they are turning away money, right? They don't need the money from certain investors. They're going to go with people that can amplify that company's sort of reach, their sort of gravitas. They can hire better people. They can enter new markets, right? So when you take those type of, I guess, those 5 examples of what a manager can do, those 5 examples all lead to hopefully investment returns, right? They've actually distributed or repaid capital in sort of bunches and exponential multiples to investors in a past life, right? Within that stratification, you have sort of the angel track record. Has that GP made money for herself, separate of that? And then when you go down that, it's like literally at a large institution where that manager, he or she, led that program or led that sort of strategy, and now is breaking off to run their own sort of their shop, right, so to speak. They're hanging out there in a shingle. So when you look at that track record, there's different gradations, or sort of in terms of, I guess you can say, when LPs take it as seriously. Because again, when you look at track record, there are oftentimes people that are products of the market, where we've had a very bull market cycle for a long time, low interest rates, asset inflation, and rounds were getting done at higher multiples very quickly, right? If that manager is investing in things like, secondaries where they did not find that deal themselves, and or sort of looking at different things that are off thesis. Say, for instance, she's launching a deep tech AI focused fund, but her track record is only in sort of, enterprise SaaS or consumer, right? Unless there's a nexus where she can graduate to that particular strategy, that track record might be diminished by LPs who don't see it as being on thesis.
Okay. Yeah. And you've kind of already touched on this already, but do you have any examples of, successful emerging manager investments and why they were attractive to LPs?
Sure. I'll plug someone that actually brought Eric and I together a long time ago. There's a fund in Los Angeles called Amplify LA that I personally invested in when I was an allocator at the family office. And Eric, my co-founder, knows Paul Brickholt, the co-founder, the founder and managing partner, very, very well, right? And shout out to Chris Bjornerud, if you're listening, sort of walking us through sort of venture capital, right? So at that time, it's a funny story. We showed up in Venice, there at Venice Beach in suits. We had people surfing who thought we were literally like feds, right? And we're like, no, we're here to see something. We're coming from a different meeting, right? But that's another story. So when you think about that example of sort of the specialty of that manager, Amplify and a handful of other funds were in Los Angeles and Southern California in venture a long time ago before it was popular. Because Southern California has always been more known for entertainment, media, real estate, and even sort of some, in those sectors, it was always the Bay Area that got more love, right? Silicon Valley, San Francisco, et cetera, et cetera. So when we think about sort of that track record, knowing a certain region, knowing it very well, and we had a thesis internally that, diffused talent would go to different places. This is pre-pandemic. LA is probably best known for Hollywood and sort of tourism, but it graduates, I think, LA County and the surrounding areas, the most engineers, I would say, in the United States, right? Or North America.
Yeah.
Forget that statistic. It should be updated. But essentially, we thought about that. We thought about sort of the companies coming out, like Honest Companies, SpaceX, et cetera. And we're like, okay, let's go figure out LA, right? So we knew that investing in public markets would not give us an LA kind of centric feel. So we looked at the private markets and essentially distilled that down to a few managers. And Amplify LA was a good example of how track record in that specific region matched with what we were doing and looking at as LPs.
Yeah, that's an awesome story. Super interesting. And so you talked a little bit about this at the beginning of the webinar where you had mentioned different types of asset classes. And I know that we had kind of briefly talked about this before, but could you touch on what role diversification plays in an LP strategy when investing in fund managers?
Okay. Yeah, I'll try to unpack that. It's a very sort of, it's a great question. It's just sort of different places, and we could talk a little like an hour for this. I would say diversification, again, when you're a family office versus an endowment versus a sovereign, all these different people that may invest in funds and emerging managers will have different diversification plays, different risk tolerance, different sort of investment horizons, and sort of different ways, needs for liquidity, et cetera, right? So if we take sort of just down the fairway, if there's such a thing of an investor that is sort of in alternatives, international, doesn't have present liquidity needs, but just needs to drive a return at sort of above S&P plus certain points. Diversification across emerging managers, I think, is very important, right? When you think about, again, all the different asset classes out there that you may sort of service, right? The types of funds, you have real estate, credit, all different permutations. You have hedge funds that are all different types of strategies, large leverage buyout to mid-market to early stage. In venture capital spans sort of pre-seed to growth equity. All these have different risk return profiles, and sort of, again, the people that control their money, it's their money, right? In most cases. So they'll want to do what they want to invest in, things that they're interested in. So diversification is a must, I would say, as we're moving away from sort of the low interest rate environment. The Fed has telegraphed that they're going to look at sort of different things versus inflation, unemployment. There's obviously a U.S. election year where I'll tell everyone that listens that there's going to be some politicking around that. But essentially, if you think about diversification in sort of where shocks happen in the form of geopolitics, war, things that happen in certain regions that affect like inputs into sort of whatever happens with outputs and sort of those top line numbers, then diversification across different asset classes is critical, right? I think when you look at emerging managers, a lot of the assets, if you have your public book and sort of that trade sort of correlated to certain things, the different types of stocks, the Magnificent Seven, et cetera, when you look at what an emerging manager is doing in, say, supply chain, right? We have a great manager, refashioned that, Brian's out there. If you think about kind of what they're doing in supply chain has sort of issues with sort of global geopolitics. But if you're enhancing sort of how they do business in sort of, letters of credit, logistics and all that, that is not as highly correlated, I would say, as like a stock on the S&P, right? Or sort of within those indices. I would say, give another example, if you look at specialist managers and focusing on certain regions, if you look at Southeast Asia, obviously a lot of money has been rotating from China into Southeast Asia for various reasons, some right, some wrong. You're looking at growth in sort of 13 different countries. That could be interesting, but it's not as correlated to, say, something happening in LATAM or the United States. So those are all different forms of, I guess you can say, strategy, stage, and geographic diversification that LPs may want to take a look at.
Yeah, this is really interesting. And I was going to touch on this a little bit later, but I think it definitely relates to kind of what you were talking about with diversification. But could you expand a little bit on how, or I guess just to back up a little bit. So we all know that it's a very difficult fundraising environment right now, that it's like, what everyone's talking about, it obviously has been for a little bit. But can you expand on how kind of the external forces and kind of the outside, market affects, what LPs are doing when they are choosing to invest in managers, and how that kind of affects their strategy?
Yeah, I would say this crowd is probably more specific to venture capital. We'll start with that, and we can talk about other things. But, real estate, even Bitcoin, Bitcoin obviously has sort of reached its like 2021 sort of heights, and we'll see whether, sort of tapers. In early stage venture capital, I remember we talked about the pandemic when we were like spraying our groceries and going to the supermarket. Maybe not in Colorado, but we're definitely doing that in the Bay Area. You think about sort of what happened there. You saw sort of everything sort of heading to the moon, despite a pandemic that was shutting down parts of the country and the world, right? So it goes back to interest rates and sort of asset inflation around interest rates and the cost of capital. So a lot of LPs in that time invest in a lot of things that were at the top of the market. And this is not to call anyone out. It's just, it looked like it could stick around for a while. Other people were paring back, but most people did not, right? So if you think about that and sort of the Fed kind of telegraphing certain changes that are coming, it is still very much correlated to kind of how interest rates are, sort of where they're at, right? And you're probably not going to go back to like a sub 3% handle, so to speak, anytime soon, right? I'm guessing it's a guess, right? So when you look at that, a lot of the stuff you invest in were at the top of the market. So with any sort of basic kind of, the lower your entry price, the sort of the more range of outcomes you have, the more more you pay for it, the higher it has to go, right? Basic sort of, stuff, random walk down Wall Street, Warren Buffett, Charlie Munger, rest in peace kind of stuff, right? So when you go from there, all that stuff is out of the market, but VCs and sort of other asset managers also did that at the same time, right? So to get there, certain exits need to happen, certain things need to happen, but the exit market is slowed down. The M&A market, even despite sort of yesterday's Discover Capital One sort of acquisition, which is in the billions, 35 billion-ish, that doesn't have the same effect, and it's not sort of indicative of what's going on early stage, right? So without those exits, without that M&A, without sort of those things, a lot of companies will run out of runway, and the managers that invest them at certain levels of the market they basically need those distributions to return to their investors, so the cycle comes back again, right? So the long way of saying, because of what's going on in the markets and sort of macro factors, the hurt is there, so to speak. It needs time to kind of unfurl itself. So yeah, that's kind of the tough part about where we sit in the market and what we're seeing with LPs and GPs. Right.
So you also talked about this a little bit with the story that you had mentioned with Amplify LA, but how do LPs typically assess the alignment of their interests between themselves and the fund managers that they invest in?
Yeah, we get this question a lot. This is not anything to do with Paul, Amplify LA, or any of the funds I mentioned. So we'll put that aside, just to be clear, right? We found really interesting enough that, because we speak to LPs almost every day, like literally we've talked to like 300 LPs, a lot of them are friends, a lot of our people I've invested with, some are new, right? We're going to market and we're bringing our software to a lot of family offices and corporate investors and fund of funds to a lesser extent. there have been weird complaints about from LPs that certain funds are bringing sort of off-market terms. So if you think about kind of when people cram into like the fees section or sort of other things like miscellaneous, right? I was a former lawyer. Those sections are this long. They're like 12-point font. There's a big footnote and it refers somewhere else, right? And you're like, okay, that's a little longer than what it used to be. But we're finding, or at least we're hearing from LPs, that they're seeing some incentive alignment that's a little off from certain managers. And it's not just VC, it's like other types of funds that can raise, or the ones that cannot raise that need to sort of, do things to, shore up whatever they need to shore up. So I think if you want to avoid, again, in this market where LPs are looking for every reason to say no, it's like if you show up late for a meeting, this document is not spaced this way. They're just like, I've got other stuff to look at, right? Because we tell our VC managers, you want to go through things with Revere and kind of understand the lay of the land instead of going out there on your own and making those mistakes with real money, right? So if something is off in the formatting, if you show up late, something gets messed up, or they don't like Calendly, whatever, you're going to lose that shot at talking to that LP that can give you money, that can be that lifeline, right? I think that is where we are very much sort of telling LPs to maintain that alignment, to make sure that it's incentive. You're starting a relationship, right? It's a 10 to 15, if not longer, your relationship with that investor, right? And essentially, you want to get off on a good foot. You want to keep open lines of communication and basically make sure that the incentives align, because you're paid a management fee and sort of be brought in to run that capital for them to make money, right? They will compensate you for that in the form of carried interest and other incentives. But again, when those things are kind of off or off market, that's bad things happen.
Yeah. And I think that's something too that I always end up, when I'm talking to a first time fund manager and they're thinking about, setting up their fund and, what they need to do to make sure it's all set up. And I think one of the big conversations is if you're going to go raise fund 2, make sure that your interests are aligned on fund 1, have everything in order and really, get it set up in the best way possible. So if you're trying to scale this and you want this to be, fund 10, fund 11, what that looks like, setting it up kind of in the best way with aligned interest on fund 1 is.
I couldn't agree more. I just cannot agree more. And I think the plug for sort of, Angela's, we've looked at Vector. I think you have to get, I think it's table stakes because of all the recent-ish SEC changes, right? You're going to see a world where all these funds, fund 1s, 2, sub 10, sub $20 million, not just VC, but other asset classes, sort of rental, data centers, whatnot. They're going to have to be audited, right? You're going to have, because it's going to be a best practice. It's required for certain types of funds, but we see that going that way. Right. And if you're doing your job properly, right? If you have nothing to hide, yes, and it's an expense, but the market, like you probably see, will follow and provide the services, in terms of commensurate with what types of funds. Pick the right service provider, right? Make your mistakes with them, go through that with them, get some friendlies to run through your pitch deck, talk about ideas. Don't make those mistakes when there's real capital on the line, right? You only get one shot at it. It's just the nature of the market. And this is the stuff that we were telling GPs even before sort of this fallout and sort of fundraising, basically dating back to like middle of 2022, where all this stuff was happening with FTX and all the banks, right? Like that's when sort of, at least in venture capital and blockchain and tech, the bottom fell out, right? Make the mistakes with someone you trust, right? Get the feedback, revise the deck, updated, get out there, talk to people, refine that pitch. They'll have a 1-minute pitch, a 10-minute one, a 30-minute one, an hour one, right? I cannot sort of tell people that enough, because I think like with any fund manager that's starting out, you're a startup, right? You're basically building your own business, hanging out a shingle. It is not easy, because if it was easy, everyone would be doing it, right? Not everyone's doing it, right? And then one of the things about Silicon Valley and sort of tech investing and anything competitive, it's not a participation medal sport. And mediocrity is not rewarded, right? So how can you transcend and get above that to be sort of top quartile, top decile, top of mind for people, and sort of get in and eventually dispel that sort of, it's a Jay-Z quote, I just did that, I don't know why. Dispel that emerging manager so you become an established manager.
Yeah. I think that circles back too to one of the first things we were talking about with those, the key criteria that LPs look at. I mean, one of them is how are you set up? Who's the team that you're working with? Like, how you set up for your back office, all of that. I think that just kind of circles that all back together. And
you do not want your LPs, like, I think, there are a lot of fund admin solutions out there. Some work with VC, some are more hedge funds, whatever. And like, generally speaking, the feedback from the GPs is what you expect, right? Like they're kind of happy, they're not really happy, they complain about stuff, and it is what it is, right? But what you do not want to do is have that LP start complaining, right? Like if you stay with a fund admin, if Vector does a great job, stay with Vector, right? Because if you sort of pick them up, move to different places, the LP, knowing that we service LPs and we have to work with fund admins to get documents in to make sure it's read, that's not a good time, right? Like obviously there's that time where fund one, a lot of friends and family capital, to fund two, you start looking at sort of more institutional investors. The rebalance is usually big from 2 to 3, vintage 2 to 3, where you're looking at sort of the bigger kind of investors, right?
Right.
Like you've earned the right to be in that conversation, right? Could happen later, earlier or later. But again, you want your solutions providers to scale with you because again, guess what, right? Like if something goes awry there, not good, right?
Yeah, I couldn't agree more. So what are some of the common challenges or risks that LPs are typically aware of or go through when making fund investments?
Yeah, it's like if you're looking at certain strategies, right? Like for instance, litigation finance versus early stage, like specialist venture capital to a Blackstone and sort of everything in between real estate, right? Provided that you have that understanding, if you're going after an emerging manager, which, between our two organizations, we know a lot of, you have to kind of make that mental leap as an LP to cross that chasm, so to speak, that you want to bet on this, right? And that goes back to what we alluded to in terms of portfolio construction, risk management, sort of all these different things, allocation strategies that is very near and dear to that individual LP, right? So without getting into the permutations, it's more, if you're looking at emerging managers, you're crossing that chasm, so to speak, and you're making that mental leap that you're going to find outperformance in those managers versus kind of the established brands. They'll get you like 10 to 20% IRR, heavy on fees. You may get access to an investor relations person, but you're never going to get to the decision maker because the decision maker is too busy and or sort of doing other stuff, right? So emerging managers, the benefits of that is, we'll go back to sort of the emerging managers that we invested in. I'll give another shout out to Metaprop New York, NYC, Zach Schwartzman. Obviously taught us a lot about prop tech, right? In addition to, we talked about LA. So we picked emerging managers at that time, basically to help learn about what was going on, right? In that sector because of our strategic needs, right? Now, if I invested in a bigger fund, chances are I probably wouldn't get that person's attention because they're bigger LPs than me clamoring for his or her attention, right? But when I go to New York, when I went to LA, when I lived overseas, I can always count on taking an hour coffee meeting with my GPs, all emerging managers, to basically get lay of the land, make referrals to other LPs and GPs that they respect, and sort of widen the network, right? I would really say that the emerging managers that I invested in my time at the family office, because I told you, Emma, careers are nonlinear. I was a corporate finance lawyer before that, really helped me, no pun intended, amplify and sort of grow kind of the, getting to know people, right? Just like going to events, talking to people, and people are more or less willing to share ideas, and that formed the basis of sort of the people that we work with today, even to today at Revere, right? So the benefits, I think, emerging managers, the majority of them will overshare in a way, like, careful what you ask for, but they share really good ideas. They're always trying to be helpful because they need it more, right? They are emerging managers. They're building their business, their reputation, their franchise, and they're willing to share. I think secondary to that, if you're an LP looking at co-investments or sort of looking at sort of ways to get into, again, expressing an interest in a market, emerging managers of all different shapes and sizes, can be private equity, mid-market, venture capital, whatnot, are usually short on cash, right? They never raise enough. If they're doing their job right, they're going to have great sort of pro rata rights. They have great follow-on co-investment opportunities because they're well known. They're going to have to fill that SPV that essentially gets them to complete that deal, finish that transaction. So when they think about you, they'll think about you as a capital source. And again, do your diligence. But again, those two things, I think, in terms of access, exposure, education, deal flow, you'll get that more readily from most emerging managers than bigger names.
Yeah. I mean, it's really so true when people say this is a relationship-driven industry. It goes with every kind of aspect of this industry, whether it's managers, LPs, service providers, we all get connected through introductions and relationships and who knows who. And it's that's definitely,
Yeah.
touches on the point.
You're in biz dev. I run sort of sales partnerships and biz dev here, and it goes to if you think about the large funds, the small funds, whatever in between,
Mm-hmm.
we're all businesses, right? We are all selling a particular thing. And it's no sort of secret that people buy things or invest with people they like, right? So if you're likable as an LP or a GP and you connect, relationships are more giving, be over generous with that intro, make introductions without sort of the need to do anything or anything in return. And you'll find that when you go to those cities, people are more than welcome, more than sort of, want to pay back that favor.
Right. Yeah, absolutely. So can you discuss some of the due diligence processes that LPs go through when they are going to commit to a fund? I know it's probably a lot of things, but would be great to, hear some of the.
Yeah, I think the funny story with some of the funds we invest in, we really put them through like a root canal. Like most people, a lot of investing, especially in funds, are sort of get the data room, take a look, sign the doc, and kind of move on, right? Others do a very deep dive for various reasons, et cetera. I'm saying you should do a deep dive, but also obviously don't waste the time of that GP, right? Time is valuable. So when you look at the diligence, you access the data room, you check out the third-party service providers like yourself. We always did reference checks for 2 investors that invested in the fund, in addition to 2 of the portfolio companies that they had invested in, right? And that was for venture capital, growth equity, to a lesser extent, hedge funds and credit. But basically, we would do that deep dive and do the reference calls, and just it was important to us, right? That was one. I would say the strategy in terms of if you're modeling it out, right? Like venture capital, a lot of times, a lot of the numbers are going to be difficult to sort of manifest themselves because things are always changing, sort of from period to period or market downturns. And it's private markets, right? So the data is not perfect compared to, what you get in the stock market, et cetera.
Right.
So from there, having conviction in sort of how you're modeling it out and sort of looking at that is a part of that. But I would say, I did it in a sort of a reverse way. When you're looking at early stage startups and even sort of fund managers, provided those things tick, you're looking at the team, right? You're betting on the team. So emerging managers without that track record and or sort of even bigger teams like a Blackstone, all strategies that, sort of these larger behemoths like KKR, Blackstone, Carlyle are not all created equal, right? Like some strategies are like their flagship strategies where everyone's clamoring to get into. And there are other strategies where like no one wants it, right? Because no one either doesn't fit sort of the return profile and or sort of it's not the varsity team, so to speak, right? So within that, look at emerging managers. You're betting on teams, right? Across the board. Go do the on-site diligence, right? Manager, like you may be in a co-working space, whatever, look the part, dress the part, be ready to impress. I'm not saying wear a suit if you're in like Silicon Valley or Venice Beach, right? But, be on time for the meetings, get ready to talk business, take it seriously. This stuff is like it's kind of weird that's lost on people. But as an allocator, I remember going to meetings, particularly in New York, where people are just so busy. And like managers that I was talking to would either be late or like something we reschedule and all this other stuff. And it's like, I'm here from Hong Kong, built in sort of a packed day. Could that meeting wait a little bit, right? So we found a bit of that as well when we went to bigger sort of financial capitals. Stuff happens. But again, for GPs and LPs, get ready at the table, have those frank conversations, be on time. Yeah.
And that leads me into kind of what I was going to ask next. And something that I hear a lot is people always say, always be fundraising. So you're always working on building, maintaining relationships with LPs. And so what are some best practices for building and maintaining those relationships when it comes to LPs and fund managers?
I think it's kind of weird to say it, but like, I'm sure you've been to 100 of these events, right? You've done this. There's certain people that are very likable, and there's certain people that are just not as likable, right? You're going to click with a lot of people and make sure you get their information, right? I think without being creepy, right? Like get their, if they like WhatsApp, a lot of Asia-based investors are on WhatsApp and WeChat. They're not as big on email. LinkedIn, I think is fine, but a lot of people, if you want to make that contact, LinkedIn, they can just ghost you and like not respond, right? So
Right.
I always feel like to make meaningful relationships, assuming there's a double opt-in, like, don't be creepy, people. Email, right? Just get to the email so that, if you're a salesperson, you can get in the CRM and you can keep them abreast on sort of what you're doing, right? Like you can send out sort of things to, people that you met in a marketing sort of, context, they lead into sales, et cetera. Same goes for funds, right? If you think about kind of people that you meet at an event, if they're an LP, don't hard pitch them. Don't like get in their face and all that stuff because we see that too often. It gets it's put offish.
Right.
But do the 1 minute thing. Oh, we're doing all this. We're focusing on this. What do you focus on, right? Get to know what they're doing, right? Because if they're only looking at AI and you're a consumer fund or vice versa, they're probably not going to invest in you, right? That's just how it is. So be likable, be affable, don't be creepy, get emails, and essentially just, keep in touch, right? If you're going to the city, say, hey, I'm coming to see, different people, I'm hosting drinks. That's a good way of organically building it and sort of without, spending too much money, right? Because we're all sort of constrained for marketing and sort of sales budgets. And just kind of be yourself, right? Talk about the strategy, be ready, right? Because to be blunt, like when you go to these events, you really never know who you meet, right? You just
Right.
don't meet. Like you're not getting the guest list a lot of times unless it's your event. Sometimes when you get a guest list, only 60% of the people show up. You got to be ready, right? Be ready, be optimistic, don't be creepy, get the contact.
Yeah, no, that's great. So just before I jump into a couple more questions, we are running up on the last 15 minutes. So in the audience, if you do have questions, please go ahead and throw those in, and then we'll address those in a couple minutes. But let me just see where I'm at with my questions. So have there been any specific sectors or industries that LPs are, currently more interested in or currently considering when doing fund investments?
For venture capital specifically, I think I'm not going to rehash AI here. I think every day it's either, the information or any sort of Axios or sort of any group going to like the Wall Street Journal and New York Times is talking about AI, right?
Right.
Like, is Sam Altman really going to raise $1 trillion? I don't know, probably. Things that are going on. Every company, kind of like we're talking about sort of how old I am because this song's from 2001, and you're like, what? When you think about .com bubble, mobile strategies, apps, et cetera, it's like, why do I need an app for that, right? That type of thing.
Yeah.
AI, we're on this platform. There's probably an AI component to it. There's an AI component to Google Sheets, et cetera, and the list goes on, right? So that is obviously on top of people's minds, but how you manifest that kind of exposure and sort of the view, chasing secondaries at $100 billion valuation, I don't know where it's going to go, but $100 billion, who knows, right? I won't comment on that, but people are looking for that as an expression of AI. You can try to bet on early stage companies. I think the YC cohort, Techstars 500, is slanted heavily toward AI, and good luck, right? In terms of those companies building the future, right? Hopefully they do. Hopefully it goes somewhere. So I think AI is obviously top of mind, deep tech to an extent. I think what's been interesting is seeing sort of, again, there are multiple permutations of food tech, right? Like you had the initial sort of Impossible, the Beyonds and all that good stuff. And now we're seeing like, dumplings that are organic, right? Like doing this from a certain region in China, right? I love dumplings. Yeah. You have like sort of second layer, like, realistic shrimp that's not shrimp, right? Which is like, kind of like, oh, okay, that's interesting. So you're seeing sort of permutations and offshoots of that, which I think is awesome because again, for the usual reasons, and sort of environmental, sort of all that diet, et cetera, that's good, right? It's good innovation and people will eat what they want to eat. So those are sort of, I guess, on different ends of the spectrum where like, what we're seeing. Obviously, I read an interesting article about one of the big behemoth known name brand VCs doing a lot of lobbying in DC, right? Because there's an American dynamism sort of defense that's basically sort of in response to kind of geopolitics, US, China, things that happen in the Middle East, Russia, Ukraine, et cetera, right? So like we see a lot of that happening where, a lot of Silicon Valley was founded and or sort of based on the premise of what DARPA was doing in addition to Fairchild Semiconductor and sort of, again, all emanating from the Cold War back in the, late 40s and 50s, right? Post-World War II. So we're seeing a lot of that sort of running the spectrum. I think LPs, again, it's their money. If they've done the risk return profile, the asset allocation, then these are all really interesting things that have legs to run. Again, there's other things like real estate where interest rates have been impacting sort of yields. San Francisco downtown is not as bad as people make it sound. Come see it for yourself. Come visit us. We're at Second and Market, et cetera, right? So long way of saying there's a lot of stuff out there. Do the work. But again, just know that there are macro factors that are lurking around the corner in an election year that could have impact.
Right. And on that note too, do you have any insights into the impact of like ESG considerations? I know we come across that a lot on the fund side now with talking to like new managers and things. So wondering if you have any insights on that.
Yeah, ESG is in a kind of a weird spot right now, given the pushback from, the states that we were talking about where,
right.
Go figure, right? Not to get sort of into that. They have their reasons. Everyone has their reasons, et cetera. So put it aside. But like it's at a weird time where like you talk about how important it is to sort of address the things that we can address, without taking a political view, right? Like we'll just say that it's good that the oceans aren't full of plastic, right? Right? It's good that we have optionality for consumers, regardless of the political spectrum, on the cars they drive, the fuels they consume, the food they eat, right? It's good. It's good for sort of capitalism, right? We're all capitalists to an extent here, right? So for me, ESG is at a weird time. No crystal ball as to how it goes. I do find it interesting that, people are digging in on each side, like, and sort of where that goes. I think usually the answer is somewhere in the middle, right?
Right.
I would say that venture capital funds, Eric, my co-founder, has always said that almost all venture is basically somewhat impact because it's trying to affect certain positive change. I mean, it's not like building a club to go beat baby seals, right? It's not venture, right? So for me, like, it's interesting to see kind of people are kind of they're either wearing it with pride that they are doing like sustainability, they're doing carbon credits. There's a great fund, shout out to our friend, Regeneration, Michael Smith, who moved his family from LA to Amsterdam to pursue this, right? Really interesting stuff, right? So for me, like the answer is somewhere in the middle. There will be sort of people that, up in arms for their reasons, others that only focus on that. But at the end of the day, that innovation, if it advances sort of our causes, you can call it whatever you want. It's good for sort of us in general as people.
Yeah. Well, that's super interesting insight. Awesome. So just a reminder to everyone in the audience, go ahead and throw in questions. I'll start going through some of them. But so what items in an LPA/LLC agreement would be considered deal breakers that would prevent an LP from committing to a fund?
Yeah, you waited to the end for the hard one. So as a former lawyer, right, law firms are not drafting the new document for everyone, right? Because it would take forever and like it would be expensive like crazy, right? Now, AI may change some of this, but there are bar association standards that are going to affect that, and lawyers have a fiduciary duty and a professional responsibility to make sure that document is crafted for that client, right? So putting that aside, God, I'm such a lawyer still. Putting that aside, if you think about kind of different forms of docs that come from certain law firms, right? They're going to be ones that are more pro-investor, right? Pro-LP. There's other going to be more pro-GP because there's a negotiation sort of a range that people will meet in the middle, right? But I was going back to the point about GPs not shooting yourself in the foot. Don't get too clever, right? Go with the doc that is down the fairway, that addresses sort of things. Now, if you have extenuating or specific circumstances, typically around fees, around what is the pass-through expense, who's on your LPAC, right, your advisory committee, sort of if you're a solo GP, right, like if, heaven forbid you get hit by a bus, what happens to the fund, right? Like, does it go to the estate? Does it revert back? If a LP defaults, what are the interests sort of going there? Those things should be down the fairway because, again, if you're all the way to document stage and the LP loves what you do and you throw something off market because either one, you didn't look at it, or two, your lawyer kind of just, had a bad day and sent the wrong form, then yeah, that's really, it's a real shame for that to happen, at that stage, right? So I think, again, fees, alignment sort of on LPs, if there are any defaults, I think the indemnification language is pretty broad, like, that's pretty accepted under Delaware. So where most of the entities are set up. But again, if your lawyer is sort of using certain terms, these are best practices, make sure they are, again, you are the client, so you make the decision. They're just looking out for your best interest. But again, make sure you're down the fairway, not reinventing the wheel to get to a stage where like it doesn't work.
Yeah, I think that also ties back to our point of make sure that you're working with the right people, because we come across, some new funds, emerging managers who are working with law firms that maybe don't play in the space very often. I've never heard of or never
using
worked
their cousin, right? That's like
yeah, exactly. And so then it gets really complicated, and a lot of that will, that's going to affect the LPs deciding to commit to your fund.
With your fund admin, with your law firm, with any services provider, right? We're not, without being too cliche, it's like the amount of money you have to spend or the heartache or whatever to unwind something versus doing it right the first time, with some tweaks here and there, it's always better to do it the first time, right? It's like it goes for everything in life. So invest in the infrastructure. We say that to LPs too, in terms of portfolio management, instead of getting someone to come do a forensic accounting, right? Same goes for GPs when you're fundraising. Do it right the first time. Focus on what else. Focus on the important stuff.
Yeah. So I know we're running up on time, so just a couple last ones, but do you have any interesting stories or lessons learned that would benefit the audience?
If you're coming from overseas, don't wear a suit to Venice or any places. You're going to a deposition, or worse, you're like you're a narc or something. Half kidding, just half kidding. I think So I've been blessed, I think, to work in different jurisdictions. Like I feel comfortable in Shanghai, Silicon Valley, Seoul to an extent, these different places, right? I've just been blessed, right? So I think the anecdote or sort of whatever is just like, if you're able to go meet allocators and go meet people in different places, because while everyone here is in this business to make money and do well, and hopefully also do good, right? I think learning from perspectives of people like a sovereign in Korea versus a Japanese corporate to like a European family office to a, sort of EMEA, North Africa focused GP and everything in between, AI specialist, it's pretty neat getting the perspectives. I think if you're a GP, it's good to know the world around you because again, you're very tunnel vision on sort of getting it set up, all that good stuff. But like, I see Riley Rogers from Valley on here. What's up, Riley? He taught me more about the Middle East than sort of anyone, right? And I've only spent we got hit by COVID, but we've spent time just learning about the ecosystem, right? I would never know this. It's not on Google, right? So things like that, right? That's one. I would say two, understand the broader world, like what's going on in macroeconomics, interest rates, because if you're pounding the table and talking about this thing, but this thing was like massacred in the market like a week ago, you're going to sound kind of not smart, right? It's going to cut into your credibility. For LPs, I think if LPs are listening, if you're coming in from a different world or you're learning new, take the time with treating with respect people's time. Take the time to learn more about those strategies through your emerging managers. I feel like they accelerated sort of my curve in terms of just learning about different spaces, different places, and strategies in a short amount of time, right? So that would be sort of my anecdote to just get out there and learn more about the world.
Yeah. Well, I think on that note, that was a really great kind of last few words to wrap stuff up. So if no one else has any more questions, we'll finish this up now. But Chris, I just want to thank you for being here with me today. This has been a super awesome session. I feel like I've learned so much. I hope everyone in the audience did as well. And I think it's really interesting, hearing from the LP perspective, given that I only really work with fund managers. So this has been really, really awesome. But just as a reminder to everyone in the audience, I will be sending a follow-up. It'll have the recording to this video, a way to contact Chris and the Revere team, and a little bit more information about what Revere does as well and how they work with GPs and LPs. Chris, any, I guess, last final things to say?
No, Emma, thank you so much for having me today. A lot of fun, asked some great questions. And again, we're here to help. You too as well, Emma. If we can be helpful with our network, we're in San Francisco, 2nd and Market Street. Come visit us. We're here to help. Thank you so much.
Awesome. Well, thank you, Chris. Take care, everyone, and we'll catch you at the next webinar. All right.
Thank you.
Bye.